You won't believe what just happened in Washington. Donald Trump and his Treasury Secretary, Scott Bessent, thought they had come up with the perfect plan to corner China. The idea was simple: squeeze Beijing so hard that it would have no choice but to back down. But China didn't retreat. On the contrary, it drew even closer to Russia, signing major new oil deals that proved Washington's pressure wasn't working. And here comes the twist. Scott Bessent himself, the very architect of this strategy, suddenly shifted his position. Now he defends China's right to keep buying Russian oil, saying Beijing has always traded with Moscow and nothing fundamental has changed. But when it comes to India, his tone changes instantly. Toward New Delhi, he is harsh, accusing the country of simply wanting to cash in. This double standard speaks volumes. The Trump administration seems to be easing its grip on China while turning up the pressure on India. That raises the key question. If Washington is no longer confident it can directly pressure Beijing, then who is actually paying the price of this policy? America's high-tech industries, artificial intelligence, chips, and semiconductors still depend on rare earth metals controlled by China. If Beijing cuts off the flow, Silicon Valley could be paralyzed in just days. Meanwhile, Japan, once considered Washington's most reliable ally in Asia, is taking losses from tariffs. Its exports are falling, and its financial markets are in turmoil. So the obvious question arises: if this plan was supposed to strengthen America, why are farmers, tech companies, and even its closest allies the ones suffering? Let's take a closer look at what is really happening. Officially, the White House says the sanctions target Russia, but from the very start, Trump himself made it clear: the real target isn't Moscow, it's China. That's why the sanctions were written so broadly, giving Washington room to use them not only against Russia, but against any country it chose. The first real test wasn't Russia at all, it was China. This was also one of the key themes in J.D. Vance's campaign. Inside Trump's circle, the plan seemed straightforward: cut off China's access to cheap Russian oil and gas, push up the cost of its factories, and make Chinese goods more expensive. That way, American companies could finally compete again. But in practice, things turned out very differently. China found a workaround. Instead of buying less Russian oil, it started buying even more, but paying in yuan instead of dollars. This not only secured China's energy supply, but also struck a blow to the dollar's role in global trade. At the same time, Beijing strengthened ties with Iran, Saudi Arabia, and other major exporters, building a whole network of partners to shield itself from long-term risks. For Scott Bessent, who had pushed this policy, the warning signs became obvious. America had miscalculated. Instead of backing China into a corner, the pressure backfired, and the United States began to feel the blow itself. Farmers lost their biggest buyer of soybeans. Companies dependent on Chinese supply chains raised alarms, realizing no quick alternatives exist. And when the White House started threatening new tariffs, the deadlines kept getting pushed back. First 90 days, then 120, then another 90. These endless delays revealed one thing: Washington itself wasn't ready to lock in tariffs because the price was simply too high. That's when the focus shifted away from China and onto India. And here lies the irony. In recent years, India had become one of America's most reliable partners. It opened its markets to investment, attracted companies, and even became a new hub for Apple after the company poured billions into moving iPhone production out of China. For Apple, India was supposed to be a safe bet, but now Washington is turning that bet upside down. The very sanctions once billed as a tool to pressure Russia are now weighing down on New Delhi too. Not because India suddenly became a threat, but because confronting China is simply too costly. India is the easier target. Even major media outlets have begun pointing out this contradiction. Why is Washington softening its stance toward Beijing while tightening the screws on New Delhi? Once again, Scott Bessent's position is telling. When it comes to China, he carefully chooses his words, avoiding anything that might derail negotiations. Toward India, however, his language is blunt, filled with accusations of greed and opportunism. The message is clear. Washington knows exactly where it has leverage and where it doesn't. In reality, the sanctions presented as a tool against Russia have turned into a weapon the US directs at whoever seems like a convenient target. And right now, India is the one caught in the trap. So why is Washington so cautious with China? One of the main reasons lies in American agriculture. U.S. farmers are heavily dependent on Chinese buyers. When Beijing cut back on soybean imports in response to earlier tariffs, the blow was immediate. In the Midwest, grain elevators filled up with unsold harvests, and farmers faced a very real risk of bankruptcy. Washington had to rush in with billions of dollars in subsidies just to keep them afloat. The stakes here are enormous. In its best years, China purchased more than $26 billion worth of U.S. agricultural products annually. Nearly 1 in every 3 rows of soybeans grown in America ended up in China. No other market on Earth can absorb that scale. If that door closed completely, the fallout would extend far beyond individual farms. Farm debt is already rising, while profit margins are razor-thin. A total break with China would crash grain prices, force families in Iowa, Illinois, and Nebraska to sell their crops at a loss, and drive many into bankruptcy. Subsidies might soften the blow in the short term, but no government program can replace a market of that size. And it's not only about today's numbers, it's about the future. For young farmers inheriting the land, the outlook is bleak. The biggest buyer could disappear. Without China, the heartland of American agriculture risks hollowing out, while Russia and Brazil step in to claim the role of feeding the world. The shockwave would ripple outward, hitting equipment makers like John Deere, logistics chains, and export companies tied to U.S. ports. But agriculture isn't the only weak spot. American corporations depend on Chinese factories not just for cheap labor, but for vast supplier networks and production lines that simply cannot be replicated elsewhere overnight. Then there's the issue of rare earth metals. China dominates their mining and processing, and without them, there are no smartphones, no electric cars, not even U.S. military hardware. Without access to these materials, American manufacturing could grind to a halt in just weeks. Trump himself explicitly tied this factor to tariffs. The last time there was talk of suspending duties, the White House demanded assurances that the flow of rare earths wouldn't be cut off. Beijing gave those guarantees, and the tariffs were quietly shelved. Meanwhile, companies that thought they could sidestep the problem by shifting production to India found themselves caught in a trap as well. Apple poured billions into new factories, betting India would remain outside the line of fire. But Washington's latest moves showed that even close partners can get pulled into the conflict. For Apple and other corporations, the signal is clear. Moving production doesn't mean safety if U.S. policy keeps shifting. Looking at the bigger picture, the reality becomes obvious. Russia may be the name on the sanctions, but the real target has always been China. And now India has been dragged into the crossfire too. The constant tariff delays, Scott Bessent's careful defense of Beijing, and Washington's unwillingness to push too far all point to the same conclusion. The U.S. knows it cannot afford a full-scale showdown with China, so it shifts the pressure onto those partners who are easier to squeeze. And if you zoom out to all of Asia, the story goes far beyond just China and India. Japan, Washington's closest ally in the region, has also been swept into the storm, and U.S. policy plays no small part in it. The latest economic numbers are troubling. Exports, inflation, government debt, demographics. Every indicator is moving in the wrong direction. Instead of helping stabilize the country, American trade decisions are piling on more pressure. Let's start with exports. In July, Japan's overseas sales fell nearly 2.5% compared to last year, the sharpest drop in 4 years. For an economy built on automobiles, machinery, and electronics, that's a red flag. The steepest decline came from the U.S. market. Shipments to America plunged more than 10% in just 12 months. Sales to China also fell, but it's the American tariffs on Japanese cars that have hurt the most. Recently, Washington announced a reduction in these tariffs, from 25% down to 15%. But it's worth remembering that not long ago, Japanese automakers were paying only 2.5%. Even after this concession, they're still paying 6 times more than before. Toyota, Honda, and Nissan can't just pass those costs onto American buyers without losing market share. Instead, they're absorbing the hit in their profits, which means sooner or later they'll face a choice: either raise prices in the US or cut production and jobs back home. And the issue extends far beyond cars. When auto exports stall, the entire trade balance shifts. In July, Japan recorded its first trade deficit in years, 117 billion yen, or about $795 million. That reversal shows just how fragile the economy has become. Then there's inflation. In July, core prices rose 3%. That's slightly lower than in June, but still well above the Bank of Japan's 2% target. The pain is most visible in grocery stores, where food prices have climbed more than 8%. Household incomes simply can't keep up. Energy costs have finally dipped a bit, but the relief is tiny compared to what families are paying for food. Now the central bank faces an impossible dilemma: raise interest rates to tame inflation, which would hurt exports and industry already strained by US tariffs, or keep policy loose and let households bear the burden. Either way, the pressure only intensifies, and if Japan stumbles too far, the impact won't stop at Tokyo. The shock would ripple through global supply chains, financial markets, and even the US economy itself. That's why this story matters. Japan's crisis isn't isolated, it's directly tied to decisions made in Washington, and if the course doesn't change, the next economic tremors will hit not only Asia but America as well. Which leaves the central question: if America's allies are cracking, its farmers and tech companies are hurting, then who exactly is winning this trade war? Stay tuned, because the events reshaping the global economy are only just beginning. And now make sure to subscribe to the channel so you don't miss the events that are reshaping the global economy. See you in the next video.